And good morning, everyone. John Hutchinson with Traders Reserve. It is Tuesday, March 3rd. Welcome to Breakfast Club. We have to spend a little bit of time, just a little bit of time, talking about some of the changes that have taken place in the last 24 to 48 hours related to the Iran conflict and how that's impacting the market. I have a little bit of a narrative, an arc that's starting to develop that will impact trading, impact investing. I want to show you how these pieces are coming together today. And then as we go through this week, we'll start to pick apart ways that you can protect yourself and still be a participant, even if the markets are in the red. Then we're going to take a look at defense stocks that are in the AI2 index, some ideas that you can use for trading investing. Take a look at the AI2 portfolio and then get you on with your day. Short version for today is it's going to be a great day to play golf, have lunch with a friend, watch the entire trilogy of the Lord of the Rings movie series. That should cover a good 8-9 hours and get you to the end of the market day, because it is not going to open up in a positive sense. Futures down significantly, much like yesterday. There's some differences between yesterday and today, and I'll walk through them with you. But one of the surprises to me, even precious metals, gold and silver down. Gold was down 2.5% early pre-market. Oil is up substantially bouncing between 7 and 8% higher. The U.S. dollar is higher. All of these are reactions to a bit of escalation in the Iran conflict that the market cares about. Let's be clear. The market cares about one thing: oil. That's it. As it relates to this conflict with the war in Iran, that is the only thing that matters to Wall Street. The impact to oil prices. And what's changed in the last 24 hours is over the weekend, really Saturday into Saturday, the original statements were, and I sort of covered this yesterday, the expectation for 4 weeks of operations and limited to an air war only, no troops on the ground. Even Lindsey Graham saying no boots on the ground. And then yesterday, throughout the day, between President Trump, Defense Secretary Hegseth, and others, it could be 4 weeks or 5 weeks or longer. And Trump saying himself, I know doesn't see a need to send in troops, but he's not sure, but maybe. That is problematic for Wall Street because it changes the limitations that were initially set, and that creates uncertainty. And that uncertainty then, it means that there's no exit strategy. That Wall Street can't price in the real risk to the oil market. The oil market has, granted, nobody likes war for oil, but it still has a downward impact on the economy. I'll show you how in a second. And that is what is raising volatility. The VIX was up at one point about 10% this morning. And that creates a more significant uncertainty in the U.S. economy, especially as it relates to not just oil, but transportation, shipping, travel. It extends much wider than we initially would think. Excuse me. So as I said, oil up substantially. The key metric here really is $80 barrel prices. If we start breaking through that and staying above that for an extended period of time, that begins to have a significant impact on our economy, especially. The main issue is Iran threatening any ships attempting to pass through the Strait of Hormuz in the Persian Gulf. That is one reason why the administration yesterday said they would be targeting the Iranian Navy to prevent attacks on ships in the Strait of Hormuz. There's secondary impact. I mean, this is literally like an avalanche here. Secondary impact, insurers, major insurers who back shipping companies um, electing their uh, war indemnity clauses, which effectively means if your ship gets attacked, we're not going to pay you a claim. So what's happening in the Persian Gulf right now is the captains of these ships are playing golf, having lunch with friends, watching the trilogy of the Lord of the Rings, maybe listening to old records from the 1970s. They're doing anything but transiting the Strait of Hormuz. And these are reasons why, not just the threat of attack from Iran, but also the fact that major insurers have told shipping companies that they will not pay claims. That's a significant negative. And it is one reason that the markets are down more substantially than they were yesterday by almost a full percentage point plus. Now, it is entirely possible, and it would not surprise me if markets open lower and bounce back as they did yesterday. May not necessarily bounce back as much as they did yesterday. The NASDAQ and the Russell both wiped out losses within the first hour and a half of the trading day. And even within our AI2 portfolio, we had a broad section of stocks that were positive on the day, including Coherent, which was up 15%, Tower Semiconductor, which was up 10%, and Prius Technologies, which was up 8%. So just because the market is opening negative doesn't mean all stocks will be in the red, but I do expect that that we have a very red start to the day. The question is whether or not Wall Street gains any confidence during the day to move the market back higher or to close that red open. The second issue that's beginning to rear its head is the US dollar, and that is trending back toward the 100 level. That has an impact on trade, especially for multinational companies. Think Apple, offshoring earnings. The cost of bringing those earnings back increases. It's negative for trade. It pressures commodity prices, except oil. And it also becomes a safe haven. It's an alternative to owning stocks. So you own U.S. dollars, you own Treasury bonds. So that sort of that flight to safety and a flight away from the risk of the general stock market. But when you put these two things together, they start to squeeze the stock market from two different sides. And when I couple that with economic data that has occurred over the last 2 days between Friday last week and yesterday, we start to see a difficult picture emerging. Going back to Friday, the producer price index surprised significantly to the upside. That was an increase in price inflation at the producer level. At some point, that inflation rolls down to consumers. And second, yesterday in the ISM manufacturing report, the PMI, the overall report was fine. Manufacturing printed printed in expansion territory for the second consecutive month. That is a positive, but there was a deep negative, which was an increase in prices paid, and that validates what we just saw in the PPI from last week. But more importantly, that increase in the prices paid, the inflationary impact, was the highest since 2022, June of 22, highest increase, the highest level in the prices paid since the last year's tariff implementations. So this is a significant negative. It may be temporary. It is worth pointing out right now that this is simply a collection of events. I'm not using the R word, but these price pressures can alleviate quickly. They can pull back. They can expand, but it is becoming the inflationary problem is beginning to rear its head in ways that I don't believe Wall Street was expecting and certainly was not prepared for. But when we put these four things together, between the ISM printing higher prices, PPI printing hotter prices, oil rising, which negatively impacts consumers. It negatively impacts the cost of moving goods and services around, not just in the country, but around the globe, and the cost of moving those services increasing. That puts substantial pressure on the Federal Reserve. I, I, I'll just go on record. Rate cuts are off the table for March. That's certain. I don't see if these don't change, and if this conflict in Iran extends beyond 4 weeks or 5 weeks or longer, I don't see how the Federal Reserve gets back to rate cuts by the summer. This is this obviously developing uh, economic situation, if you will. But at the moment, we start from here's where we are, and we'll begin to move to what can we do about it. But we need to understand first whether this is just a one-time print, because it can be. If it's a short war, then oil prices will eventually come down. If it extends beyond the month of March, though, you're starting to get into spring and summer travel season. That's going to have an impact on consumers. We already saw last month retail sales were flat. We have retail sales being reported again this Friday. The consumers, if consumers are not expanding their spending, that's going to become a problem for GDP. And then you can start using the recession word, but I wouldn't yet. I would still say we want to see multiple prints of economic data validating that trend. And by multiple, I mean 2 to 3 months. But these are the starting points. This is the point at which you start to worry about it, not necessarily the point at which you take drastic action. So that's why I put these in that context and show you how these dots are beginning to connect, and not in a positive way, and also as a way to share or to show you why the market is opening at a deeper negative. Nothing substantial really changed. Iran had already threatened the Strait of Hormuz. They always do. But this collection of events is beginning to weigh on the market, and weigh on the market in a way that is deeper than was originally expected. One area to look at for potential opportunity whenever the market stabilizes, and beyond energy stocks, so oil stocks will likely be up. Utilities may actually do okay today as well. But one area that you can look at is our collection of AI plus defense. Because as defense stocks get used up, they have to restock. They have to increase manufacturing at the defense level and replace missiles, missile components, semiconductors and chips and memory and things of that nature, right? The entirety of the defense network begins to need to be replenished. And there are a number of stocks that fit within both the recovery or replenishment of those stocks, and also this cross section of artificial intelligence plus defense capacity or capabilities. And that is anything from drones to intelligence to satellite monitoring, things of that nature. So here are 6 companies: Northrop Grumman, NOC. They were up strong yesterday. Palantir had a nice rebound day yesterday. RTX, Patriot, and PAC-3 missile defense. Those are missile defenses that are largely used with allies in the region. Lockheed Martin, which builds the F-22, I think that's the F-22 Raptor, the F-33, F-35, excuse me, also up yesterday, 3%. AeroVironment, a drone technology leader, and L3Harris, a communications, intelligence, and surveillance satellite company. So you look at these 6 stocks, all of them have solid numbers, solid performance numbers, financials, fundamentals. Their charts have been strong, most of them have had strong charts going into the first quarter this year, largely on the back of expansion of the budget for defense. That was part of the bill that was put together last year with Donald Trump and the Republicans, et cetera. So you start to combine this idea of companies utilizing artificial intelligence with defense. There's a little bit of a thesis there, a narrow path for investing or trading these stocks. Many of these stocks have options that can be used. So if you're an option seller, exploring the option chain can be of significant value to you. And AeroVironment has been a pretty strong leader in the AI sector as a trading stock. And Palantir, obviously, everybody knows Palantir, right? But LHX is a company that I'm paying attention to right now. I think they have a very solid chart, and that's a company that I'll be reviewing at some point in the next week as I continue to do more research around this confluence of AI and defense stocks. So ways to approach this is to think, do I want to trade it or do I want to own it long term? Some of the stocks that are best for short-term trading, a couple that I didn't mention, Kratos Defense, KTOS, a little bit of a streaky stock, but again, AI-powered drones that between Kratos and AVAV, AeroVironment, that's drone development, management. They both tend to be a little bit volatile, but that's perfect for trader, right? You ride it up, take a short-term gain, let it ride down, and then jump back in on the next move up. A couple of areas too. You can think of these in terms of defense, but XLE, XOP, the energy ETFs, carrying forward the cost of oil increase. Those should move higher in the short term. ITA is an ETF for companies that are breaking out to new highs with clean technical setups. So these are some different ways to defend your portfolio and incorporate some of the defense stocks that we just talked about. If you're looking on a longer term basis, Lockheed Martin, RTX, Northrop Grumman are all strong for holding throughout the year. They may have a nice pullback where you can get a better entry price given the current run-ups, but I don't see anything on the horizon where those stocks are going to suddenly collapse. Palantir is a little bit more difficult. We talked about that stock last week when we were looking at fundamentals. I'm less high on Palantir strictly because their forward price to earnings ratio isn't as pretty to me. It isn't as compelling to me as other stocks. So as we go through this week, next week, we'll take a deeper dive on some of these companies and see which of these companies may have the right mixture of fundamentals and technicals and value for the potential growth that they may offer. On the portfolio side, we had a strong rebound yesterday. We are going to open lower today, and I can't hold on. The dogs are enjoying their moment. There they are. All the dogs are quiet. Let's get back to it. We're going to open lower today, but yesterday, as I said, we had a wide swath of our stocks that had strong up days. Coherent has moved from a 13-14% gain to nearly a 30% gain. Sienna holding strong. Semtech, Tower, Semiconductor, Amprius all moved from the negatives to positives yesterday. We may give that back today. But at the end of the day, we're still holding a strong return for the year, and patience as the market starts to find a bottom and or recover from current levels. I'll be looking for where I can add to some of these positions as secondary purchases to reduce my cost basis and potentially gain on recovery and or expand the portfolio to take advantage of new names in AI and defense, or in other areas that we talked about yesterday, optics, connectivity, and even security and security software. So there are still going to be opportunities, and we will take advantage of them as we have the potential to do so. That is going to be today's update. Again, the main thing is keep our eye on everything that's taking place in Iran. And uh, as that has an impact on the overall markets, the oil markets especially, but we will take our opportunities as we have the potential and move from there. Um, More importantly, I'll be back tomorrow with a preview of Broadcom's earnings and any additional fallout from today's market action. So with that, hope everyone has a great day today. Hang in there. Howmet's another great stock. That's a stock that I'd recommended. Thanks, Adonova. Adonova. I'm not pronouncing that one correctly. I apologize. But Howmet, another excellent stock to look at. My focus here was really the connection between artificial intelligence and defense. But you're right, Howmet is a strong stock. That's a stock that I had originally put in my 2024 portfolio back in February of 2024, and we project that was back when it was trading around $50 a share. Still a very strong defense stock to consider as well. So great call on HWM, Howmet, and uh, that's it. That's Breakfast Club. We'll have the recording up here in just a few minutes, and then I will see you again tomorrow morning at 9 o'clock. Thanks for joining me.